All right. Hello, everyone, and welcome to the Innov865 Investor Series sponsored by Three Roots Capital. My name's Courtney Piper. The Innov865 Alliance is an advocate for Knoxville startups and entrepreneurs, ensuring our ecosystem is strong, vibrant, and connected. The Alliance is best known for Innov865 Week and Startup Day, which is a week-long celebration of entrepreneurship in September. But we also do year-round event programming, information sharing, and celebrating our community successes. Founding members of the Alliance include Three Roots Capital and our host, the Knoxville Chamber, as well as the University of Tennessee Research Foundation, Oak Ridge National Lab, Launch Tennessee, PYA, the Knoxville Entrepreneur Center, UT Anderson Center, TVA, the UT Research Park, Veteran Ventures, the City of Knoxville, Techstars, and Bunker Labs. This evening, our investor series will focus on preparing your business for an ownership transition. Chris Miller, CFO of Three Roots, will introduce our panelists and moderate the discussion. So, Chris, welcome.
And actually, I'm going to let the panelists just introduce themselves. So, panelists, come on up here. I just think it's kind of awkward when somebody introduces you and you have to kind of stand there and hope that they got all the data points right. Jason, we'll let you go first since you're sitting right here immediately next to me.
Thank you. Thanks for having us here. I'm Jason Chung. I'm with Tradewinds Advisory. I've been in finance all my life. I went to school down the street at Vanderbilt, and then I went to business school after that, and then I went to New York, and I started as an equity derivative trader, and rode a wave of all these crazy derivatives that were being created on Wall Street at the time. But I grew up in Huntsville, Alabama, and wanted to move back to Huntsville. And so I did, and realized in Huntsville I had no saleable skills whatsoever after having been a derivative trader. So I learned about companies, I learned about software, I learned about biotech, I learned about engineering companies and manufacturing and all different types of companies. And since I stayed in finance and ran a couple of hedge funds, but what I found being in Huntsville was that my passion was always around the entrepreneur. It was always around small companies, helping them grow, helping them exit. And so that's what I really became my full-time job. I had a business model where I would typically invest some of my own money into a company. I would take a board seat, and then I would help them through different strategic, the decision set that the company was faced with. And it was really through that I got a kind of a broad-based experience, and allowed me and my current partner, Randy, to get together. And, we really work with all different types of businesses across different industries. And today we see, because of the market, we do a lot of M&A work. We're doing a lot of exits, and that will not always be the case. There's a lot of times there's capital formation going on, but I think I'm like going beyond my introduction of myself, so I'll turn it over.
All right. Yeah, so I'm Randy Smith. I'm a Nashville native, but I live here in Knoxville. I tell people I'm a recovering CPA. I spent 20 years in public accounting. Then from there, I left and was the CFO of a software company here in Knoxville, startup software company. We licensed software to hospitals. We grew the company to 400 hospitals in 38 states over a 15-year period, sold it to a big private equity firm. And along the way, that's where I met Jason. He was advising us as a company, and we started talking, and we just said, listen, we need to do something together. So as my tenure there ended, eventually we were able to get together and form Tradewinds. And like he said, we do what we consider strategic finance with companies, and then transaction advisory. We work on both the buy side and the sell side. We've helped companies acquire other companies, but like he said, as of late, with all that's going on in the market, I mean, there's so much M&A activity on the sell side. So that's where we spend most of our time. With that, I'll pass it on to you, Grady.
Thank you, sir. I'm Grady Vanderhoffen. I'm the founder and chief executive officer of Three Roots Capital. Three Roots is a finance company, a community development financial institution. We have about $128 million under management. We make loans and equity investments and subordinated debt investments in companies and projects really throughout this part of the country. I've been raising and investing capital in this part of the country for about 21 years. I actually met both of these guys about 20 years ago when Randy was CFO at that company and Jason was advising them. So I've known these guys for some time. Previously raised a couple of different venture capital funds. So we've been investing in and selling companies to get our capital back out of those companies for 21 years. And, we felt that this topic, for a lot of reasons that will be discussed today, this topic is very relevant because of our observation that there's a lot of opportunity, there's a lot of activity, and there's a lot of ignorance around this topic and in the business owner community. Business owners who can grow and run their businesses very successfully and then don't really have any idea how to get their wealth back out of their business at the appropriate time. And that's what gave us the idea for this session, and that's why we wanted to engage these two sharp, experienced guys to participate in that discussion. I appreciate you guys being here. I appreciate the Chamber for hosting this, and let's get on with the show, sir.
Sounds good. So as we talk about this tonight, you've got some overlapping skill sets and perspectives, but what I hope you can see is that you're going to get the input from someone who has investment experience in providing capital to those companies, both, I'm sure, having been an investor on the side of the company being acquired, and then also having participated in investing in the buyer of some of those companies as well. You've got accounting and finance perspective from someone who has been advising the company and the owners of the companies on how to prepare and structure for those events. And then you've got advisory and sort of what I'll broadly say is kind of management and strategic consulting type services for companies that are going through transitions of ownership as well. So multiple different perspectives, but all focused on transitioning ownership in a company. So if you follow us on social media leading up to this event, there were some data points that were being shared that came out of a book that I think Randy recommended, which was Walking to Destiny by the authors Christopher Snyder. And just to share a couple of those to frame this up, America has 6 million privately held operating companies representing approximately $15 trillion in wealth. 2/3 of those are owned by baby boomers who would like to sell their company in the next 10 years. Only 20% of owners, though, successfully sell their company. 67% of owners are not familiar with the full range of exit options available. 78% of owners do not have transition teams and plans. And only 18% have had a formal valuation done of the company's worth. So, jumping into the topic, let's begin with our first question. What are the motivations to transition the ownership of a privately owned business? And Jason, we'll start with you.
There's the ultimate exit where the owner have decided on their own that they want to sell the business and the market is right. So a lot of times the owner will not decide that they want to sell their business, but the market is right, which is happening today. And that's some of the transactions we've worked on lately. The owner had no idea that they wanted to sell their business, but multiples are at such a high level for those particular industries. And there was so much capital chasing those types of companies that the owner said, okay, let's sell because I may not see this sort of exit opportunity for the next decade. There's another one where the owner dies, becomes disabled, something bad happens, and the market will accept that transaction because there's enough of a company there that even though the founder is either not there or disabled or whatever has happened, there's enough of a company that it will keep running and a buyer can take that company out and get a return on the company. And then there's times when there's an owner who is at retirement age and they need to sell, but the market's not good. And that's one of the worst situations that you can have. If the company is, there's certain things that you can do to prepare to make that a successful transaction and a successful transition for the owner, but the owner's not going to be there at the company at that point because they want to retire, and that could impair the value from the buyer's perspective of, wanting to purchase that company.
Randy, next question for you. When should someone start thinking about transitioning ownership of their business?
Very early on. I mean, ideally it's years before. We work with some companies where they know they want to exit, but they're not ready. I mean, they've got to get their human capital in place. They got to get the right management team in there. They may have some structural issues, on their balance sheet they need to get cleaned up. Companies oftentimes are attractive, but they're not sellable. And so starting that process early and getting everything ready, if you want to maximize the value, at the end, then there are a number of things you can do along the way to get the company ready. And so we always recommend the earlier the better. You got to start thinking about it.
So Grady, next question to you. What are the primary types of transactions that are used to transition the ownership of a business?
Well, there are at least a couple, and I'd be curious if these guys want to add something. There's a stock sale and there's an asset sale. And there are all cash transactions, there are leverage buyouts, but a stock sale and an asset sale. When an owner is ready to sell their business, the tax ramifications, and I'm not a tax attorney, but I know the tax ramifications of those two different types of sales are very different. If you sell the stock in the business, you're going to pay a capital gains tax, and if you sell the assets in the business, you're going to pay tax another way. It's very possible to sell a business at a price point, same price point in a stock sale or an asset sale, and one scenario will be much more lucrative for the seller than another sale. And so there are a lot of nuances and factors that go. It's not necessarily as simple as the owner says, well, I'm ready to sell. I'll take $5 million for my business. And the buyer shows up and says, I'll pay $5 million. We need to do it as an asset sale. Well, that's going to result most likely in that owner paying more taxes than they would if it was a stock sale. And some of these nuances are things that an accountant, a CPA, the right kind of CPA who understands M&A transactions, and an attorney who understands these types of transactions can advise the seller of the business to maximize the value of the sale, even at the same price point, two different deals. And then there are considerations around, is the buyer paying all cash? Is the buyer borrowing capital? Does the buyer want the business to borrow capital, which is then used to buy out the owner? Which is a kind of a leverage buyout, and which you can do on a large scale or even with a small business. So those are some examples of the types of transactions.
So Grady, follow up on that. So Jason talked about who sells their business. Who typically buys a privately owned business?
Well, I can speak from my experience with the private businesses that I've been involved with. So specifically, strategic buyers. There might be a company that's working in the same industry as the company that wants to be sold or wants to be acquired, and that company will come in and buy the other company, a strategic acquirer. Maybe that company wants to buy that company because it adds some strategic value to the acquiring company. Sometimes the company might make an acquisition, or I would say sometimes a private equity group would make an acquisition. It would be a financial acquirer. Someone who's buying the business for the financial benefit of owning that business. It's an institutional strategic acquirer, an institutional financial acquirer, and then also a high net worth individual might buy a business. They might see a business, it's something they know about, something they have an interest in, and an individual might buy a company.
I would add to that, because this is what we see today. You have a lot of private equity money out there, and they may get interested in a certain industry sector. So it may be HVAC or automotive supplier, and they will buy a platform company. So they will buy one company in that specific industry sector, and then they will use that company as the vehicle to start making other acquisitions. And so what they're trying to do, the financial play behind that, is that a small company is worth less than a larger company. It's called a size discount. So if you have a smaller company, companies are bought based off their earnings typically. And so and the earnings metric that's used is EBITDA. And so the acquirer will try to aggregate all these companies within the same sector and pay 6 times, 7 times, 8 times EBITDA for those companies. But when they can aggregate enough EBITDA together, they can either go to the public market and maybe get 20 times EBITDA, or they can sell it to a bigger bigger private equity fund and go move up that valuation change to a higher multiple and get more money for it by creating a bigger company. So that's what's happening a lot today.
Yeah, and what we're seeing in the marketplace today is really interesting. I mean, these private equity firms are getting into so many types of businesses that traditionally they haven't. I mean, historically they look for real solid recurring revenue businesses, but they're in the HVAC business. I mean, they're all over the place. There's so much money out there right now chasing deals. And that's driving the multiples up. Typically, historically, the financial multiples tend to run a bit less than the strategic multiples, because for a strategic buyer, they see a company and think, gosh, this is a perfect add-on. They put 2 and 2 together to come up with 7 or 8. But in today's world, the competition with the private equity, because as of late the debt has been so inexpensive, and interest rates being low, and a lot of these are leveraged transactions. So that's driving these multiples up. So we're seeing the strategics and the financial buyers a lot closer together.
Yeah, I was talking to a private equity analyst earlier this week, and car washes was one of the things that they were looking to roll up. If you receive an unsolicited offer to purchase the company, how do you know if it's a good offer? Whoever wants to take it.
That has been a lot of the business that we've done lately. There will be a company that's just working along, doing their thing, and they are growing, and they get an unsolicited offer to buy their company. And so I would say that typically that first offer to come in and buy the company is not the best offer they could get. And so what you have to do at that point is really understand the marketplace of where you are. Because of the size of company you are, what is the multiple being paid for your company? And almost as important as the price is, what is the structure? What are the terms of the deals? And it's always important to understand what's market. What is being paid right now? What are the structures that are the most common right now? Because you could get dinged on either one, but the business owner, having operated their business, they're not in tune with the market. So it is imperative for the business owner to understand exactly where the market is right now for their business to assess, is that a good offer or not?
Yeah, another part of that, what we see out there, most business owners have spent a lifetime trying to build a business, and they're very good at it. They understand growing a business, but then they get to this possibly once in a lifetime transaction, and this is just something new to them. And if you think about it, on the buyer side, you've got private equity firms that have very high financial expertise in there. You've got these strategic buyers that it may be a company that's got a whole merger and acquisition department. So there's a lot of financial sophistication on the buyer side, and the seller typically doesn't have that. They just don't have the experience. They've never done this before. That's where we try to come in and try to level the playing field. I mean, we worked with a company not too long ago that had gotten an unsolicited offer. they'd gotten actually 2 different ones, and we had to do a lot of things to kind of help clean these up, get them competing against one another. When you can get multiple offers, you're gonna get closer to a market value for your business, because the buyers, they want to buy, they know they make their money on the buy. They want to buy it, as inexpensively as they can. And so, what we want to do is to try to bring that financial sophistication to both sides of the table to really help the seller.
Let me add something on that.
Yes, sir.
I saw a statistic recently that said that 65% of small business owners don't really know what their business is worth and may, in fact, have never had an audit. And in my experience, when someone approaches a business owner about buying the business, they do want to validate. They're going to make an offer. It's probably going to be a lowball offer, but they're going to want to validate the value of that business. The owner might have no idea what his or her business is worth, and in fact may never even have had an audit, because it's a closely held business where they're the only shareholder, they're the only one that cares, and so they've never had to validate their financial statements for a third party. And that's one of the things that might be required to determine what is the true value of a business, so that then the prospective buyer and the seller are talking about the same information and looking at it the same way.
So I think one thing I'm hearing is that just because you've received, or the company has received, a letter of interest, you don't start celebrating. So how long does it take to usually sell a business? And I know sometimes that letter of interest comes early in that process. Sometimes it doesn't come until you're months into that process, right? So how long does it usually take, and what are some of the key events that happen in the course of selling a business?
So when you get an LOI, there's typically, you don't sign the LOI. You talk to strategic advisors, you talk to your attorney, your accountant, and you really look at the LOI and you try to determine, is this a good offer or not? And you go try to test the market. So that LOI will say, this offer expires in 30 days from the time of receipt. You need to look at that 30 days and yawn. Because if they were interested enough to buy your business, they know you cannot possibly make a good decision and sign the LOI within 30 days. And so at that point, your work begins. But even if let's say it was a good offer and you want to take it, there will be multiple turns of that LOI that might take weeks. Then from the time the LOI is signed to close, I can tell you that historically, and I'm talking for the last 2 decades, it has typically taken 6 to 9 months to close deals. Today, we had one where we signed an LOI and we closed it, was it 60 days? 60 days from the time the LOI was signed. That never happened historically, but today, deal teams are getting more sophisticated, they're getting better. Attorneys are getting more specialized, and so you're finding the time from LOI signing being compressed, but I would still say that, it's 6 months, 4 months to do, for the buyer to do all their due diligence and for you to get the purchase agreement. So the LOI is not the purchase agreement. The purchase agreement comes later, and that is the heavily negotiated part when you're talking about specific terms of the deal. The LOI is highly negotiated when you're talking about just the financial terms of the deal. But I would say, it takes 6 months from the signing of the LOI to be conservative.
I would say, a factor that can affect timing very significantly that you might not think about up front is the knowledge and experience and sophistication of the advisors, attorneys, and accountants involved in the transaction. If the buyer has a very knowledgeable, sophisticated, and experienced attorney, and the seller has Uncle Joe, who might be the greatest Uncle Joe in the world, but has never done a transaction of this nature, it can make the transaction and the process so inefficient that it will just slow everything down. And I think time is the enemy of all deals. And there's a certain amount of time that it should take to get a deal done. If it takes too much time, there's some likelihood the deal's going to die. And involving an advisor or an accountant or an attorney in the deal who doesn't really know what he or she is doing and is learning on the job will really slow it down, make it inefficient, unproductive, and potentially even kill what would otherwise be a good deal.
So I'm going to put a pin in talking about those transaction specialists and come back to it. But one of the things I'd like for you to share with us, Jason and Randy, is if it's so unusual to be able to close a deal in 60 days, what would you say were the 2 or 3 things that deal had that helped it get closed in such a compressed time frame?
I would say their financials were really clean. They had a really good management team that was clearly, it was a good fit for the buyer. It was a private equity buyer. It was a really good fit for them. They just had a lot of the things in place that worked well. We had a good M&A attorney. The quality of earnings analysis that they did and due diligence went really smoothly. I mean, it was just, everything just lined up really well. And the buyer was very motivated. The buyer, this company was going to be the platform that they were going to start building a fund on, and they were very interested in getting this deal done. Well, we knew that early on, so we could sort through and get through a lot of things pretty quickly.
Do you think that company started thinking about selling their business on day one of that 60-day process, or had they been thinking about it prior to that?
They had been thinking about it prior to, but it wasn't. I mean, they'd just been thinking about it. They didn't. I mean, this company was very well set up. I mean, their records were clean. It was just a simple, a smooth transaction. And the things that we see that blow up deals, things like revenue recognition issues or sales tax or warranty issues, or sometimes attorneys can blow up deals. None of that was present. I mean, it was all pretty clean and smooth, and it just it went well.
Using a sports analogy, kind of the blocking and the tackling of running the business was being done well, which then allowed and set the stage for a very compressed closing period. Yeah. And also, I've observed that a lot of times the best business operators are the ones that begin with the end in mind. In other words, they try to run themselves as though they are a company that's going to be acquired by somebody that's going to run an exhaustive due diligence process. And that's just because that's what's in the best interest of the business. Not because they're necessarily trying to sell the business, but because they're doing what's best for the business. So when that buyer comes, they're ready. Jason, what staff members should be involved on the transaction team for the company?
So it's very important for a business owner to make sure that they understand that when they start to engage on a transaction, particularly if it's a unsolicited bid, that transaction may not happen. So we call it broadening the tent. So in the beginning, you need to be able to answer questions to the buyer. And so it's typically your CFO and yourself. And in the beginning, you want to keep the tent very small, because sometimes it doesn't go well with companies when employees hear that we're going to get sold. Everyone's worried about their job. And it may be great for them. The actual transaction may be great for them, but it causes a lot of undue angst. So it's broadening the tent as necessary, but you have to be able to provide the buyer with the information that they need. So every company has A players in their team. It may be a chief operating officer. It may be, just a VP, but you have to start small and then start expanding, knowing that you have to answer the questions of the buyer crisply and accurately.
Yeah, and kind of following up on that, we treat the whole privacy issue very, very well. I mean, very importantly to us, the privacy for the business owner. Think about it. The business owner doesn't have anyone to talk to about this. They think they can't. They can't talk to their employees or anything about it. If it gets out that the business may be for sale, employees could leave. It's very, very important. For our business, this is why if you try to Google search us and look at our website, we don't have a website. And that's by design. We do most of our business by referral only, and we don't want someone, if they see a business card or something like that, we don't want an employee to get on the web and say, Tradewinds, oh, wow, they do transaction advisory. We're about to be sold. We try to be really careful with that because, as Jason was saying, the tent is very small at first, and then there's a strategy for how you expand that tent up until closing so that the whole thing goes well with your employees. The communication goes well. That's a real important piece of it.
So jumping off that and getting into the idea of involving outside consultants, it sounds like Tradewinds has kind of a process. So at what point you expand that tent, and that's probably a great value that you can offer to your customers. What are some of the other things that having a transaction specialist involved? What are some of the other ways that you add value through that process?
Well, we're a little different in that we wind up being with the business owner from the beginning through the closing and even after the closing, because a lot of times after the deal is done, there are follow-up issues. Maybe it's final tax returns, maybe it's the working capital adjustment. I mean, there are a number of things that happen after the deal's done and everybody's gone. The business is sold, there's no entity left, and so you've got either the majority shareholder or there's what they call the seller representative there that maybe is trying to handle all this stuff, and we help them through that. We've got 3 deals we've worked on right now that we're still, one of them's over a year old. We're still trying to get everything cleaned up so it can be put to bed and all that. That's one thing.
I think the most important thing is, so there's an entire community of investment bankers, and that's who most people at a certain size level use to sell their business. And they will run a process. They'll go out to 50 buyers, 60 buyers. They'll put together a book, and then and they'll try to get some interest, and then they'll have an auction process for the company. And I think that is a perfectly reasonable way to sell your business. That's not really what we do, but they're doing the most important thing, I would say, in creating competition. So we deal with companies typically that are smaller, and maybe an investment bank will not engage with them because the deal size is only going to be $15 million or $20 million below their threshold. But we get involved with those companies. But the most important thing that we do, or we try to do, is create competition. Because if there's a single offer coming in, then it's hard to hold that single offer accountable to the marketplace. So we try to generate competition. And what happens a lot of times, and it's happened on our last couple of deals, the eventual purchaser was not the person that generated the reason why the company called us. So generating competition there's no better way to get a higher price.
So Grady, what are some of the other outside consultants that would be involved as part of the deal team?
Jason made a point about the size of the company. A company that has raised capital from outside investors, particularly institutional investors or professional investors, the investors in that company may have relationships with attorneys, accountants, investment banking firms, et cetera. Small companies that haven't necessarily raised money from outside investors or from professional investors may not have any of those relationships. They might know a banker, but it's not an investment banker. They might know an attorney, but he isn't an M&A attorney. They may know an excellent CPA, but it's a tax attorney, not a transactional attorney. And those are some of the resources that a business needs to engage. And I think, the idea of having an advisor who can sort of quarterback that process, I think is very valuable, because there are different skill sets and different expertise and different experience that's going to help the company maximize the value, run a productive process, you save their taxes, achieve a successful outcome, et cetera. And so there, I think depending on who you are, I'm a sole proprietor. I don't know some of those people. Oh, I better go get somebody who can help me find those people. Or I've got a board of sophisticated investors. Let me leverage that board to help me go find some of those people. But those are some of the resources we need.
And any of you can answer this question. What is the cost of not having the right expertise at the table when you're trying to sell your business?
Yeah, that's hard to get your hands around because you don't know what you don't know. I mean, I spent 20 years in public accounting, and I didn't see the things that I see now. The things that I'm exposed to now, because it's sort of like I kind of liken it to a sort of a medical analogy. I mean, if I need heart surgery, I don't want to go to a general practitioner. I want to go to a heart surgeon that has done this every day and understands exactly what they're doing. And they've just done it so much, they understand where all the moving pieces are. I mean, there are things we see in transactions that other people may not see just because we've just done it so much, and we know the arguments on both sides of the issue, and we understand this is an issue that we really need to push. This is one that we don't, and that sort of thing. So, just having that experience is just super important.
Grady, question for you. What role does an investor play in preparing to sell a business? So I'm asking this question from the perspective of you're the investor in the business that's getting ready to be sold. What role does the investor play?
Well, I think there are several. As these guys were talking about the tent being small and who can the CEO of the business talk to, an investor in the business can be a sounding board for the person who's running the business, because they're an investor in the business. They're not an employee in the business. So I think an investor can be an advisor. An investor can be an access point potentially to some of the advisors that are going to be needed in the transaction, whether it is an investment banker or an attorney or an accountant. I think if the relationship, sometimes when a company's being acquired, sometimes the guy that's running the company or the lady that's running the company, they're also being acquired. And they're going to become an employee of the acquirer. And so there's a certain relationship dynamic between the person that's running the business, if they're going to stay in the business, and the person that's acquiring them. And the investor isn't going to become an employee of the new business. So they don't have to have sensitivity about what is my relationship going to be with my boss when this deal is done. So sometimes the investor can just have a different relationship with the acquirer, right? If there's a good cop, bad cop dynamic, or if somebody's going to push back hard on the potential acquirer, it might be difficult for the CEO to do that because he's pushing back on his boss, whereas the investor is not. They're pushing back on the buyer. And I think that's a role that an investor can play that sometimes people inside the business can't play.
Jason, what does the closing process typically look like, and how long does it usually take?
Well, I would say the closing process is between the signing of the LOI and the actual close. And so that was the 4, 6, 5 months that it would take. There's something called a Q of E, which is a quality of earnings. And most sophisticated buyers are going to come in and do this quality of earnings. They're going to verify everything is as you said it was. All the financial statements that you delivered to them, they're going through all this process. And so I think an interesting thing that a business owner has to think of is, do I have the staff inside my company to deal with KPMG or PwC or Ernst, who's the quality of earnings company that's coming in and looking at all my books? And can I keep running my company and get through this due diligence process and the Q of E? And so I think that that's super important, that you make sure that if you don't have those people inside, that you staff up in order to get through the closing. But once the quality of earnings is done and the legal due diligence is done, then typically the closing happens right after that. So if you want to talk about time to closing, it is those are the long poles in the tent.
Thank you for clarifying. Yes, I was referring to quality of earnings in the legal due diligence process. And then, Randy, question for you. Are there any specific tax events or consequences that should be considered as part of the sale of a company?
Absolutely, absolutely. I mean, there's the structure, of course, the asset sale versus the stock sale. The buyer typically wants to buy assets because they pay for the assets and they can depreciate those, write those off over time. The seller wants to sell the stock because they get capital gain treatment. So there's the tension there. And it's just sort of a side note. It's interesting. We see with the private equity firms that are driving a lot of these deals, they're not quite as concerned about that. Most of them are not, because they have so much leverage in their capitalization, in their cap table. They're using so much leverage in the acquisition. They're getting these huge interest deductions. They're not quite as concerned about that, and they're willing, and of course the competition too, because they know the seller wants to sell the stock. So they've backed off on that a little bit. Another one that we see is charitable gifting. Sometimes the owner, we worked with a company where the owner wanted to make a significant charitable gift, and so we helped him structure it so that he set up a donor advised fund, and then immediately prior to the transaction, he contributed some of his stock to the donor advised fund, and then the donor advised fund sold it. So he was able to get the tax deduction for the value of the stock, but he never had to pay the tax on the appreciation in that stock for the stock that he gave, to the charitable organization. So there are a lot of tax issues hanging around. Of course, the final tax return for the company, typically if there are transaction fees and everything, transaction costs in there, you want the buyer to be able to, the seller to be able to deduct those, as opposed to, them getting lost in the wash, or we've seen it where some of it gets allocated to the buyer, and that's not good. So there are a number of tax issues in there that really need to be addressed to get the best answer.
I'm going to open it up to questions from the audience here in just a minute. So if you want to be thinking about if you've got any questions, we'll be glad to take those. And while you think about that, I'm going to fire off 3 or 4 statements, and you're going to respond with take it or leave it. Take it meaning you're buying what I'm selling. Leave it meaning you're not buying what I'm selling. All right, we'll let all 3 of you answer, but we'll start down with Grady. Some private equity firms do actually make good buyers.
I'll take it.
I'll take it. Take it.
Okay. Company valuations will increase over the next 2 to 3 years.
I'm going to leave that.
I would probably leave that as well. Depends on the industry, and I know that's a terrible answer. I would say it depends on the industry.
Cash flow is the best way to value a business.
Depends on the buyer. For a financial buyer, yes.
Yeah, take it. I'm going to say that if the company has intellectual property that is uniquely valuable, then cash flow is maybe the best metric, but usually cash flow is.
Inflation will level off in the next 12 to 24 months.
Jason has to go first on this one.
All right, Jason. Who knows? You're the Wall Street guy. Especially, who knows? Who knows? I agree.
Succession plans don't influence the value of a business.
They do, so I'm not leaving it. Leave it out. I'm definitely.
And then the last one before we open it up to questions, relationships are an important part of selling a business.
Absolutely.
Take it.
Absolutely.
Okay, questions from the audience. Yes, sir.
How do you guys determine what the market is? You talk about market for a particular vertical. What do you guys do to figure that out?
So I'm going to repeat the question to make sure that it gets into our video. So the question was, how do you determine what the market is when you're looking at a specific industry vertical?
Today, there are so many roll-ups happening. There's so many private equity funds that are backing certain companies or just doing the roll-up themselves that you have to find who are the acquirers today in that vertical. And I think it's if you can get to who those buyers are and the companies that they're acquiring, you have to adjust for the size and the geography sometimes, or the strategic position of the companies within that vertical. But I think you can get to the market by talking to who the current big buyers are.
So on the edge of that question, are there resources that a typical owner or founder can go test the waters with data or information that's accessible to them without having to go through somebody who's super well connected to these valuation determining what the market is? I mean, where do I go look to say, I wonder what the market is for this right now?
So are there resources generally available to just the public if they wanted to go test the water and kind of see what valuations and multiples look like?
That's kind of a tough question because, if you look at the stock market, or if you look at publicly traded companies and they're buying companies at certain multiples, a lot of times that doesn't translate. That's difficult. When you get down into the middle market or the lower middle market, it's even more difficult. I mean, the best way, as Jason said, the best way to determine the market is when you start to get competition, when you start to get a few players in there looking at it. It's really tough because over the course of my career, I've seen people, companies like, I know someone who's got a company that traded at 15 times EBITDA, and so you're trying to interpolate that to your business, and it often doesn't work.
I have a question. I want to ask you guys a question. Let's think about like PitchBook as an example, the data that's in PitchBook. Do you guys think, and in the companies that you're working with, is anybody utilizing data out of a generally available data source like PitchBook to get an idea what their company might be worth?
Do companies use PitchBook?
Owners, if they're going to sell their business, or buyers.
So PitchBook, the problem with PitchBook is so expensive.
It is.
And I think that if you're just a buyer and you're doing this one-off search, it's not like going to Google. You sign up for a year-long subscription, and it's very expensive. However, that houses a lot of really good data. So find a buddy who has PitchBook because it's sort of like if you're in the stock industry having a Bloomberg machine. It's like there's a lot of really good data there, but yeah, it's really, I'd say the expense is prohibitive.
So I'm trying to reorientate myself to a different market segment. So came from California, Texas before that, venture guy, never started a company without thinking about how it might get acquired, all that. So the EBITDA thing, multiples of EBITDA doesn't, I don't get that, right? Because, acquired by Intel, acquired by this company, acquired by that company. It was always about what they could do with the technology. So I guess my question is, doing a little bit of translation here, is that still a thing in these markets? We're still, talking to, creating the marketing story to the buyer of, this is what our business could be if it was in your hands. This is how it would scale, that more strategic, longer-term vision to create really demand and your stuff. We should probably own this company. We should own these people. Kind of thing. Does that still ring true in this market?
So I think it's a great question. Let me see if I can accurately represent it. The question was, in this market, do we still have companies that are being acquired not because they're a valuation. It's a multiple of EBITDA, but because they're bringing some value or key component to another company who thinks that they can bolt it on to something that they're doing, or it enhances something that they're doing, and the valuation is entirely driven by whatever the potential thing that the acquirer can do with what they're buying.
Right, and you're talking about the difference between a strategic buyer and a financial buyer. There are just so many financial buyers out there right now. We see a lot of those. Now we do see some strategics, and the strategics can pay some crazy multiples because, again, they're putting 2 and 2 together and coming up with 12 because the synergistic value of adding that technology to their company is going to take them places they couldn't otherwise go. So that's very valuable.
Yeah, so I guess my question is, does it make sense for the companies in this space to try to figure out how to position themselves to be a strategic purchase, as opposed to just, hey, this is our finance, this is our income flow, right? It's
if that's possible, but the strategic it's a much more narrow band. A lot of financial buyers can look at, the EBITDA. EBITDA is just a proxy for cash flow, operating cash flow. And so, a lot of there are lots of different financial buyers that can acquire a business, but it's much more of a narrow band for a strategic. If you can do that, that's great. If you can start in the outset and say, I want to build this, this software company that, that can be acquired by these 4 or 5 or something like that. But that's a more narrow band. If you can do it, it's great, but it's just hard.
What you're talking about is creating some sort of intellectual property, trade secret process of doing things that is unique and the big company doesn't have. And so when you see these crazy multiples that are being paid by larger companies to acquire these small companies, they typically have that IP, and the larger company says, we have the customer base, and this small company can't get to our customer base because we've got them entrenched. But if we had their technology and we can deploy it over our customer base, then we could make a lot of money. And so it's that intellectual property that is so important to them, why they pay the multiples of revenue, and they don't care about the earnings, because if the acquiring company is trying to get them as early as possible, get that technology. They want proof that a customer will buy it. They're going to test the crap out of it to make sure that it's applicable to their customer base. And so they are paying. It doesn't even make sense because a small company doesn't even have earnings. They probably just raised money and have just done nothing but burn money to create that.
Yeah, so specifically, I'm just thinking in terms of like your planning for an exit. Right? If I don't get retired in 5 years, is there stuff you can start thinking about? How do I start positioning it where I've got IP or process or some branding, right? That can position myself more as a strategic purchase, less as a financial purchase.
It's hard to plan for that because you have to come up with some real special sauce. It's and the market has to say, yes, that is truly special sauce. And you have to think about that strategic company. What with their hundreds of millions of dollars, they couldn't create that secret sauce. So that's what you're up against.
I do think there was a phenomenon you used to see out on the West Coast. You don't see it, I don't believe, as much anymore, where you would have earlier stage companies that would get acquired by later stage companies, and it wasn't as much influenced by IP, or definitely wasn't influenced by cash flow, but because they were grabbing up talent. They wanted talent for the ideas and things that were coming out of the talent. But I don't think you see that happening as much anymore. It feels like the market is very much in a place where there's a lot of cash. We all know that there's a lot of cash in the market right now. The stock market doesn't look like a particularly attractive place to put that cash. Bond markets don't look like a particularly attractive place to put that cash. Inflation is dwindling the value of that cash on a daily basis. And so people are looking for opportunities to pour it into operating companies, because that's kind of the best play that they've got right now. So is that kind of consistent with what you're seeing?
That's true. That's what we're seeing. We're even seeing family offices, a private family office that wants to be an acquirer. They want to, saying, gosh, instead of putting our money in a private equity fund, we would rather we like this business. We can buy and hold it. So yeah, you've got a lot of them doing that.
I think you're seeing family offices too that are saying, hey, we like this vertical. We'll go hire some experts in this vertical, help to empower them to go pick a platform, and then we're going to platform and bolt on off of that, and we're going to use all of our family wealth to try to build out that way. So, other questions from the audience?
So mine is really centered around like how you tiptoe into a deal, either from the buyer's perspective or sellers. But especially when you are dealing with buying a competitor or looking at a merger or something like that, like, and especially true in market, which is for my industry is kind of more common. But like, at what point is it like, you know, I understand we sign NDAs and you know all that stuff, but like at the end of the day, I'm showing financials or they're showing mine, you know, so there's a certain level of trust that has to be there. But I guess at what stage is that recommended, or is that like, how do you kind of tiptoe around that and delicately get into that without, you know, but still having the option at some points to be like, hey, no, this isn't right, this won't work, and still be competitors?
That's a good question. So how do you kind of tiptoe into a acquisition or sell situation where maybe you've got a competitor on the other side, and how do you handle that from sharing financial information or other confidential information with your company?
Right. You know, it's kind of funny. What you see a lot in the marketplace is one company will talk to another company and say, "Hey, we want to talk to you about partnering," and oftentimes that means we're interested in buying you. So that's kind of a buzzword. But you know, on the if someone were approaching, you know, my company that way, or even talking, you know, kind of tiptoeing into that, like you're saying, you want to be very careful about what you release to them, the financial information and all that, even with an NDA. I mean, even in the transaction process, a lot of times when we've got a letter of intent, you know, a letter of intent is typically non-binding, okay? And so you're not really committed until the closing happens. And so you want to be real careful about the release of information until you know they have the financial capability to get the deal done, until you know they're committed. They've spent enough money on lawyers and everybody. I mean, you know, so managing that information release is probably the answer. That's the best way to do that. I mean, you can talk in general terms, and you know, it's a friendly conversation, and yeah, here's kind of what we're doing, but you don't want to give away, you know, your secret sauce for sure until you've got something formal.
There's a very standard set of terms in a normal NDA when you have a buyer coming in and making a bid on a company. When you have two companies that are side by side and it could be a merger, the NDA grows, it balloons, because you start to talk about customers. If I disclose certain customers, you can't come after them, you know, or geographies or IP or, you know, the financial stuff. So all the action is going to take place around that NDA. But I can tell you that for a deal to get done, there's nothing better than sitting down with the other side and having a conversation and being careful, but also there's a little bit of the, you know, I'm going to tell you a little bit about my business. Do you tell me the same about your business? And this back and forth, because nothing gets a deal done better than just good human interaction and just knowing, oh, yeah, this feels good. It's a good fit. And then you get to the battering ram of the NDA and all that negotiation. But to tiptoe in, like, there's nothing better than having a good conversation. And if they're cagey, then you're like, you're cagey too.
In the spirit of trust but verify.
Yeah.
How do you do that? Like, how do you don't get any of that, like,
Yeah.
you can have that human conversation with somebody. Obviously, you want to trust them. If you're going to do business together, you want to trust them. But trust but verify. And so, you know,
It's hard to verify. So you're going to have that conversation, and you're just going to have this feel of like, I think this person's got high moral character, and you know, I'm comfortable now going to an NDA and really starting to talk turkey. You can't verify. You know, there's nothing also better than reference checking. asking everyone that you can find in that person's network, good guy, good gal, and you'll hear stories.
Yeah, it's
been easier than now, right? With the social, whatever.
yeah. It's kind of like you're dating in a way, I mean, you're feeling them out. I mean, is this someone I want to do business with? Is this, and as you just have those conversations, they'll disclose certain things that'll tell you yes or no. And do I want to get married to this person, to this company?
Before we wrap up, any closing comments, observations, or questions for one another from our panelists?
I'll make a comment. I'm curious. I wonder if you guys have an opinion. I'm personally curious. I don't know what the answer is, but for the last, 5-10 years, certainly the last 5 years, there's been a huge amount of liquidity and unbelievably cheap money. Low interest rates, high liquidity. I think that, and the stock market's been booming, super conducive to mergers and acquisitions. Now the cost of money is going up. We're still going to have liquidity for some time, but eventually maybe not as much. Inflation. What effect do you guys think that's going to have on the M&A market in general? I anticipate it's going to slow down. Probably not this year, but maybe next year. I'm curious what you guys think about that.
It will slow down. We've seen and we're still in this golden period, but we've seen something I've never seen in my entire career of money coming into M&A, acquiring companies. A lot of companies that would be considered unacquirable are getting decent multiples, or too small and they're getting bought. But nothing will throw cold water on this more than higher inflation and higher borrowing costs.
So on that positive note.
Well, I just want to thank everybody for coming out. I want to thank our panelists for doing this. Jason, particularly making the drive up from Huntsville, finding your way across I-40 to get here. Randy and Grady, also thank you to you as well. I want to thank Dennis Corley with Three Roots Capital. He kind of spearheaded and captained putting this whole idea of this panel together. Thank Piper Communications for the work that they've done to get this set up and handle a lot of the logistics and the promotion for it. And the Innov865 Alliance for the work that they do to support entrepreneurship and small business in this area. And the bar is still open. There is still lots of food left back there to eat. So please enjoy yourself. I think we have the space for like another 30 minutes or so. And thank you, everybody, for coming.